Hi, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A session for June 1st, 2023. Got Brian, Greg, and Damien with me. So this is Brian's question. And so looking to improve the supported spring crossing and supported fall crossing entries. And on the chart, you've got the PSAR dots numbered, 1, 2, 3, and 4. And the question is, as we're moving into a potential SSC, do I trail the buy entry on the last PSAR dot as soon as the chart paints it, and then buy that with, and it's either, do I buy it with the price, or is it the RL10? Because on the tactical trade, there's almost always a significant difference between those two. Particularly if the pattern was a harsh winter and starts reversing sharply. What you'll often see is the dragon will be like that, and the PSAR dot is on the far side of the dragon from price. And it was this harsh winter which often ends up with the last bar looking like that, and maybe it was here and sold off, and then it reversed and came all the way back up. And then it's not unusual to see that thing go 1, 2, 3 and go. And then it wasn't until this bar closed here, and then that PSAR dot printed, and then the next one starts here, because it always prints where the peak of the RL10 the other way was. So now I'm somewhere in that bar when this one prints, and I could be getting entries up around here when the move was already this, and it could be a 2 or 3 hour move. And so now what do? Do I trigger off the price? Or it's not unusual to see that the RL10 is lagging that first little bit, and it may only be here when the price that you would act on is somewhere inside that bar. And so you get quite a difference on these explosive moves. Now, sometimes things are very orderly, like on DIA. Like this is the opposite of that. This is as orderly as you could be. It has this tiny little box. And where do I want to enter? If I zoom in and look at that, come on. What I actually like to do, let me just, short story first. In order to handle the problem of a sharp sell-off and then sharp price moves north, I will just stand by. I need to mute. Yeah. If there is an orderly move like this one in DIA, which is typical, I don't mind waiting for the RL10 to hit the PSAR and then just enter inside of this candle when price is in the dot, if I can say it that way. or getting it at the open of the next bar, which is when this prints. But because of this phenomena that often the best moves after the harshest winters feature a rapid explosion, I like to execute on price. And what I will actually do is a -2 bar. So when this is the live bar, I go back -1, -2, and then I draw a trailing entry stop here, so that when I'm in this bar, if this suddenly just burst through there, I would buy that here, because that is equal to the PSAR dot 2 bars ago. Then when this bar closes, and now we're in this one, I drop it to here. And then when this bar closes and it opens somewhere in here, then I would end up buying that right here, because price was now at or above this. Or actually, in this bar, if this thing closed like that, it would still be this one. I wouldn't have bought that yet, but on this one, I end up buying right in that region. So I like to, the answer was, I like to be 2 dots behind on price. And then when you have a real orderly move like this, it never violates that. You get these long series of dots down, and then finally you get a really narrow box, and then it flips, and then it almost doesn't matter whether it was price or the RL10. But what I really like is when there's a harsh sell-off, that recovery move is usually violent, and I want to get it. I'm either going to do a 1, 2, 3 entry, so it would have been like it sells off hard, 1, 2, then the 1, 2, 3 entry is basically taking out the high of the second bar. So this is bar 1. This one is bar 1 because that's the lowest low. And then this one is bar 2 when it closes, because it has a higher low. And then when that closes right here, then I can now say when this one opens, that is now bar 3. And then I buy the breakout above bar 2. And that is so I'm buying the second recovery bar, if you will, the 1, 2, 3 entry. So that's the earliest I will. That's not necessarily the earliest. So there's three cases. There is like an MMRB off the bottom. There's a 1, 2, 3 entry. And then there is the PSAR -2 entry. And then I could say RLXD. So this is what that looks like then. So when this, on the MMRB, when this thing, especially if there was a big long tail, and this thing it was just horrible. When this is like twice the size of a normal bar, there's a thing called a bottoming tail, which looks like this, that it opens here, has a huge horrible sell-off, and then closes. So it's sold off and then closes, and so you get that great big long tail. That is usually the bottom. And now here's the story that supports that. So when I first started doing the TC2000 bundle, and this was about almost 20 years ago, I was working with the very first guy who became a full-time TradeStation programmer. And he was part of the authors of the book of the TradeStation Bible, an 800-page book on how to program TradeStation. And he created the TradeStation bundles 1, 2, and 3 for us to automate our mechanical trade frames and systems with backtesting and parameter stepping, and then the ETF2 system, and then also the blended monthly rebalancing. At the time, you could not do portfolio testing with TradeStation, but he wrote code that allowed you to do it. So you could actually backtest a full portfolio, and then you could do parameter stepping, and so he just did some genius work in that. So he flew out to Kansas City, and for 2 days in a hotel room, all I did was dictate pseudocode to him, and he turned it into TradeStation code, and we built the bundles, in 2 days. Well, while we were just hanging around, I said, well, what's it like to be a full-time TradeStation solution provider? And he said, well, it's interesting. And I said, well, what did you learn from that? He says, one of the few things besides your stuff that I pay attention to is bottoming tails. He says, in any time frame, if you get some kind of downward move and then you see a giant bar that looks like this that retraces, and it's like, and both the open and the close are in the upper 20% of the bar, so you have a very large long tail, and the size of the bar itself was twice the average size. He says that's a bottoming tail, and he says just put a stop here and just buy the damn thing and see what happens. So I always remember. I said, does it work in the other way too? And he says, yes. Topping tails do the same thing. So if you have something like this, and then you get this amazing move up, and it sells off and then goes all the way back up, but doesn't make it, it's a lower close than the open, that is very vulnerable to sell off because it's an exhaustion move, and they really couldn't make new highs, and that thing becomes very vulnerable. It's not as powerful as the bottoming tail, but it's sort of that extreme one bar contains the entire turning point at once. What I normally like to see is something like where it slows down into the tiniest little doji. That's what I like to see. That's the max pain and then range compression. And then I like to set that sucker up with a small risk box and then just play the trade in either direction. And you will recognize that as the search for the MMRB. However, it comes to pass that in the SSC, you wanted a harsh winter. Well, if it turns out that you have a special case that the last bar in the winter was this horrible big red candle that opened here and then sold off hard and then already started coming up, there's a reason to believe that that's a tradable bottom, right? So what came out of that for me was, well, I already know what the MMRB is. So when I see that kind of harsh winter and sell-off, and I see the low of the day down there, my first inclination is just to say, well, let me just put the MMRB on it, and if that thing reverses and comes the other way, then shit, heck, what's my risk? That's the lowest risk trade that there ever was. Because if this thing turns out to be a false breakout and just fails through that, guess what's going to happen? That's your collapsing dragon in a nutshell. Because all of that pain and suffering that terminated in this long, painful bottoming tail, and then it failed some more, that thing's going to zero. So you take the 1 hour loss, and now you're into the trade that you wished you had in the first place. So that's the essence of the collapsing dragon, but all of that is inside the bottoming tail. And that's all based off of the idea of this MMRB. So the thing sold off, and I always know what the low of the day was, and then I just have some kind of, maybe my MMRB looks like this, and maybe this thing looks, so I just have sort of a buy order right here. Then if this thing does turn around and comes up through here, then I'm in just based on an MMRB off the bottom. And I know from intraday what the plus range stat is for the upper limit. And so I've got 9-1 in my favor. And I already know that if it fails, I'm into the trade that I prefer. So when to enter that first case is an MMRB off the bottom, especially with the bottoming tail. Check or hold. So the next one is the 1, 2, 3. And that's simply you got some kind of ordinary sell-off, and then this thing was the working low of the day. Or if it's a swing trade, the working low of the swing. And then it closes here. And then the other bar opens here, moves around, and then wherever it closes, this is tentatively a bar 1. It's not officially a bar 1 until bar 2 closes. When bar 2 closes, then and only then do I know if the low of that bar was higher than the low of this bar. If this bar's low is higher than the low of that bar, then and only then is this now officially bar 2, and this is officially bar 1. Check or hold? So now when bar 2 closes, I can officially say that's bar 2, and now this is bar 1. And now wherever this thing opens, and intraday there's not going to be any gap, so it just opens right here. Now what I have is a mechanical entry, call it 5 cents or a penny above the high of bar 2, is my automatic entry. While this bar is live, I will enter there as long as it has not made a low lower than the low of bar 2. All right? So while bar 3 is live, this thing could do this, and as long as it does not make a new low, and now it reverses and goes up and takes this up because it now broke out to the upside before it made a new low, I'm long, and my stop is below the low of bar 1. And then I already know what my MMRB is. And it's always is, if the MMRB is lower than where that entry is, then I'm still going to execute on this. But now I've already capped my loss to a 0.8 R loss. Execution R loss. Check or hold? So you can end up getting, so the MMRB gives you almost like a money management 9-1 estimate of but you actually have some tactical context information that tells you what price confirms that the upside move has failed. In this case, because I'm using a 1, 2, 3 entry, then it's the low of bar 1. Any price below the low of bar 1 is new information that tells me the sellers have gained new power to drive this price lower. Because now in bar 3 or 4 or 5 or whatever, it was able to achieve a price lower than they could get on what was previously the low of that swing. Check or hold? Okay. So the MMRB off the low is one way to just get in and just get it. and be done. Just get in. The next one is the 1, 2, 3 entry, which is I've described here. Now I can talk about the idea of the trailing PSAR by 2, right? So this thing is coming down. So the first one was the MMRB off the bottom. The next one was a 1, 2, 3 entry. And now we're going to talk about the PSAR minus 2. So now the bars are in here. So this bar is live. There is a tentative PSAR dot drawn on that, but it's not stamped in ink until this bar closes. Then and only then does that officially go in. So while this bar is live, and in this case I've drawn it as a 1, 2, 3, I mean, I could have actually taken the entry right there according to the 1, 2, 3. But if for whatever reason I don't, if I just whatever, I don't even have to have a reason. When this bar is live, then this is the minus 2. This is the minus 2 PSAR dot. Okay. Because this one's 1 bar ago, this one is 2 bars ago. And then I'll just draw that line here and say, look, if for some reason this bar, somebody comes in with a huge order, massive quantities, and just drives that thing north, that 1 bar rocket ship move is going to run away from the RL10. So the RL10 will have followed this down, and somewhere in here it'll make that pivot, probably right there. And in this bar, it's like right here. But then that thing takes off like a scalded ape, and it blows through this one, and then it closes here, and then that thing prints. It may not even be till the next bar that the RL10 continues on. So I may be getting into it on the next bar up. And now I've lost the easiest move of all. I couldn't get into it. So that's why I like I always know where my MMRB off the low entry is. And I always know what a 1, 2, 3 entry is. And I always know what my trailing PSAR minus 2 entry is. And I'll just take one of those. Now, if you have a really orderly move like this, you end up being able to get the RLXD occurs inside here, and it also coincides with the PSAR flip. So that's not a bad entry in that one. But DIA is one of those that doesn't move like this and then like that. It doesn't do that because it's too big and fat. But something like AI or Tesla might. Go ahead, Greg.
You know how you have a Kata 2 challenge? Have you ever had a challenge or someone who just does the 1, 2, 3 for entries and exits and just runs with that like as a whole model?
Yes. What I'm actually gonna say though, it's not just the 1, 2, 3. This was a kid that's using a refinement of that called the WMB3. And this is Woj. And he's got about 3,500 trades with this, and he crushes it. So the WMB3 entry actually is older than the RLCO Generation 1. Because what I was trading 20, 25 years ago was the morning hook. And it was just a phenomenon. And what I was doing was swing trading one day at a time. And I would have something like a 5-day down. These are daily bars. So there's the 5th day down. So there's 1 day lower low, or lower close, close, 2, 3, 4, 5. 5 lower closes in a row creates the 5DD pattern. The mechanical entry for that is simply 5 cents above the high and 5 cents below the low. And so this is the yellow zone here in the middle. And our rule became, look, we're just going to wait wherever this thing opens up. When it goes up through here, then we buy it right there. And then that is our stop here. And then we wouldn't be surprised if it moves to the 10-day high. Well, when we first started trading, we noticed that there was a lot of times when we would get a gap down and it might not even violate the original red line. And then looking at it on intraday, on 3-minute, 5-minute, 10-minute bars, this thing would just do this. There was something really powerful about the high of the day breaking out. Now, sometimes it would fail immediately, like false breakout and fail, or if thing would just go to forever. But we notice that, look, like, dude, look at that move intraday, and I'm sitting here waiting to buy it at 22, and I could have bought it here at 20 with a 20-cent risk, you know? Because if it violated below the low of the day, I was going to go short on a 5 DDF. So then we evolved the rule that said, look, if we're inside the yellow zone intraday on a valid swing trade setup, you can trade in the yellow zone if you can see a 2-to-1 inside the yellow zone, which means that you have to have some kind of measure of manageable intraday risk, and you had to be able to see 2 units of reward just to the mechanical high. So that would allow us now to buy this, and then at this moment when we are entitled to buy it mechanically for a swing, we're already holding 2R off a position size of this, and now the risk on the swing trade is already paid for with the money that we made. And now you could decide to add your swing trade and just cash your day trade. Lather, rinse, and repeat. And then as long as you take off the intraday load, and then you just have a much wider stop for the overnight swing, you could keep trading in that direction as long as this signal was working and it hadn't hit your exit for the swing trade. Thus was born swing trading one day at a time. So as we did that for a couple years, and we said, the best one of those, pardon my language, the best one of those was the market closed here, and then it gapped. The bigger the gap down, the better. And then if it sold off fast and then reversed harsh, that was even better than if it gaps below yesterday's low and then this holds. That's the best trade of all. So we said, how could we describe that? And it looked like it happened in the morning, and it looked like a quick fish hook. So we just called it the morning hook. So somebody said, well, what do you mean morning hook? And I said, that's what I mean. Well, what do you mean when you mean that? So I said, all right, God dang it. Good questions make me refine my... So WMB3. So we're going to use a 3-minute bar. I think, is that what we said? 3-minute bar. Yeah, so the first thing is it had to be oversold on Williams %R. Well, that happens automatically if it closed here and gaps open down to here, because it includes the previous day's data. So this thing already starts at oversold. So we set up a chart that looked like this. %R. And here was the 50-yard line. So the first signal was the Williams %R10. had to go below minus 80. And once it did, that rule was done. It had officially been oversold. Later on, we'll see that's the equivalent of a harsh winter. It has officially gone into oversold. But we said, look, on a WMB, if it goes into oversold, then that's good. Then the next thing I'll do is read up, and now I will look for the MACD H, and then here's the zero line. And if the percent R was oversold, then mathematically the MACD bars were below the zero line and going down. And then we said what you had to have was an uptick on MACD-H. So you had to see this and this. Now this only happens when the bar closes. So when that bar closes, so you had one thing that was sold off harshly, it was oversold, so there was some stream of things that went down, and then it got a little better, and then when the bar closed, the bar that closes that makes the MACD histogram uptick, now you're good to go. Now you're going to buy a breakout on a 3-minute chart. So we take this bar and we said, look, as soon as it breaks above that, we're buying it, and our stop is going to be here at the swing low of that sell-off. Now, this was before we knew what an MMRB was and all that stuff. We just said, look, that's the amount of information that this thing has to fail through the previous swing low to invalidate the idea that it's going up. But this simple little rule of WMB3 became the way that we operationalized the morning hook. Afterwards, we started adding more and more refinements to this thing, so that we added the regression lines and the Bollinger Bands and the crossovers, and we added frog boxes and then partial frog boxes. But the basic principle of WMB3 is still valid. And Woj liked it so much that he started just trading that. He's got about 3,000 trades in it, and he crushes it. And it's still a really good idea. And what it does is it's compatible with the idea of the MMRB off the bottom and the 1, 2, 3 entry, because it forces you, it gives you the oversold conditions, which is the equivalent of a harsh winter. It gives you the MACD uptick, which is the equivalent of the R10 bottoms out and you get the RLXD. And then it has the equivalent of price went through the PSAR, so you get this mechanically computable go or no-go rule. It made a new high or it didn't. And then it gave you very clear guidance on what your trade pattern risk was, so you could define that as one execution risk. So what we're discovering in a lot of Woj's work, and if you go into the chat room and just search on WMB3 in search in Campfire, you're going to get about 500 case studies of that. And I may just put a folder in the Foundations course and call it WMB3. I actually think there's a rule set in there where you can see some examples and case studies. But also if you go to YouTube and just type in on my channel WMB3, there's a ton in there as well. But he's crushing it with that. So when you get any, and this happens during the day as well, it's not just the gap down, but if you had something like a Kata 2, it could be that the sell-off in the Kata 2 was enough that it goes into oversold on Williams percent R. Beauty. And then you see it starts to improve, and then you're going to see an uptick on MACD histogram. That's good. And then you end up buying it in the pocket when price crosses the dragon, and that's the equivalent. Or you get a 1, 2, 3 entry inside here, and then you just buy it. And the whole idea is that you don't overthink the entry so much. As long as you know, I think the most important addition to this whole idea is knowing what your damn MMRB is. If you know what that box size is, then you're never going to take more than one execution R. Because, for instance, if you had a COTA 2, and went to the bottom of the drag, that might be half of your MMRB. Like in here, this is so close, that's probably less than an MMRB in DIA. But that would be the price level that you would execute on to exit. So all you do is you say, look, I'm going to, if I take that exit signal, I'm only going to take a minus 0.5 execution risk. And then if I set the whole MMRB to a 0.2 loss, and I only take half of that, that's a trivial hit. That's a minus 0.1, so don't even sweat it. Just freaking take it. And if it works, it's going to pay off huge. Because what if you only get one position sizing risk? So if you get like a frog box risk or something. So you have a little MMRB, and it gives you a frog box of returns, which is like a 3R. But you had already set, because of this little thing here, you were only going to end up taking half a risk box anyway. The reward to risk on that is so good that you don't even care about trying to fine-tune the rule set on this side. As long as you know your MMRB, and you have a pattern with the percent %R and the MACD histogram and the COTA 2 with the higher lows, you've got enough statistical evidence that that might be a turning point. And you're getting in earlier, off the low, and MMRB off the bottom, you're okay. In the same way that you can actually use things like the width of the Z-score, or the width of the Bollinger Band means, that kind of stuff. Like, let me see if I can draw one here. Makes sense. The worst thing that this ever got to, well, here's one where it went outside the Z3 because this was so narrow that it gapped down and then sold off to here. Well, there's your 1, 2, 3 entry right away. Now, it turned out that this thing didn't even get to the Bollinger Band mean, but when this thing starts rolling over, it didn't even get through the dragon or to the Bollinger Band mean. You have no compunction about cutting that one at a scratch. Because if this is going to work, it's supposed to go through the Bollinger Band mean, past the PSAR flip, and out here into this land. And if the sooner that it fails, the sooner you just cut it because you don't believe in it. You never believed in it. You were expecting it to fail. And in fact, this is the perfect example. You end up getting long here, and it doesn't work, and you end up cutting it like right here, and then you get this trade. And it never looks back. Because you're on the side of the angels. You're below the Bollinger Band mean, the river's sloping down, the PSAR trend is down, and you got into this because that first one failed. And it already gapped down and sold off once, and this thing just oozes to the south. So you want to do some search on WMB3, and then, like I said, the MMRB off the bottom is one reason to get in. The 1, 2, 3 entry is a reason to get in. The PSAR -2 is the one where you're just, as this thing keeps marching down, you're drawing these trailing entries in the same way that if price was going down like that, and you said, well, here's my MMRB entry off that, if that was really the low, then my entry is here. Let me draw price in blue. So that was the price, and then it closed here, and then it opened here, and then did this. You know, now your entry is here, and then it just keeps selling up. So as this thing keeps going down and then closes, you say, well, shit, there's my MMRB off the bottom. And so if you just put a trailing buy stop on that thing, then what will happen is on the bar that is this enormous trailing bar, or the what'll turn out to be a bottoming tail, that thing sells off, and then inside that bar it starts running all the way back up, and you always know where your MMRB is off the bottom. Hey, you could just put an alert on that, and you could decide to execute or not, or you could just take it. I would just take it. And then all you got to worry about, oh shit, I'm surprised I'm in. How soon can I get my stop to no lose plus dinner for two? And then it's just a science project. Who cares? My risk is out of it. And it's that first powerful move off the bottom that's amazing. Which is why, in the long run, what I like about the max pain range compression is that you have the smallest possible yellow zone and the largest move to recover, or the largest second leg down ever, and that makes this thing my favorite entry, because now I can go in either direction. I'll take the first breakout. So the max pain range compression is a logical extension of this WMB3, which was nothing more than trying to get the morning hook. And then the RLCO framework became a statistical treatment of the dynamics of location and volatility to give us a different appreciation for what price is doing, in a way to describe the market condition. And then the second generation of SSC and collapsing dragon and owls and emerging dragons, and then Kata 2s, where we have that continuing rising high, were ways to operationalize specific patterns that we saw. So that's what I want to say about that. The short answer to your question there, Brian, was PSAR -2. But I feel like you deserve the background, the backstory of where, and then Greg's good question. Look up Woj. And for about the last 18 months, he's done nothing but WMB3s, and he's crushing it. He uses 4 symbols, like, if I remember, Tesla, Devon, Brazil,
NVIDIA.
And NVIDIA. And he just kind of says, well, there it is. And that's as much diversification as he needs. And somebody before asked, well, how do you develop a list of things that are of tradables? It gives you, those are far enough apart in concept that something is moving. And the mover pays for all the other ones. And sometimes they all move. And those are massive days for him. So, yeah, the WMB3 challenge is what Woj is doing. And it works on every time frame. So one of the things that we found was in the research weekend was we were doing that for the intraday because it really helped with the gap down. But other guys that were just doing swing trade says, well, what if I just use that as a refined way to do the channeling system? It's overbought. I got a MACD histogram uptick, and I buy a candle breakout on the next bar and use that and use the swing low as my stop. Perfect. Because it gave you a slightly wider stop rather than just yesterday's bar. It gave you the stop all the way to the swing low, which was logical for a 1R. And and then you end up getting Kata 2s after that, the continuation pattern, which is nothing more than a universal re-entry after you exited a successful trade. That ends up working. So all that stuff is good. Now, what I would say is if you go into the chat room and just search for WMB3, you're going to be happy that you did.
The you mentioned when you're describing this, the width of the Z3. Is there off the top of your head, does that
Say that again.
the while we were just talking about it, I made a note and I wrote width of the Z3 for the
Oh
score.
yeah, yeah,
Is
yeah,
that
yeah, yeah, yeah. So here's another, just sort of another rule of thumb, and this is where the pattern 7, the Z-score trade, comes from. Oh man, let me find it. Hold on, let me. Yeah. So it looks like this. You can actually, when you see a price that goes beyond Z3, you just take the width of Z2 to Z3. That's so it's the Z score, and you just say, if it went below Z3, let me buy Z2. And this is not a great one to look at it with, but you'll see the point on this. The idea is this excursion beyond Z3 signified something unusual. And so what you would say is, at some point right about in here, I can buy the Z2 and then just use one standard deviation at that time as a Z boundary. And then I know, because of the Z-score ladder, I know that's the exact same distance from Z2 to Z1 is this, and then to the Bollinger Band mean is that. So if you can buy Z minus 2, aiming for a reversion to the mean, and use 1Z as your execution risk, you mathematically have a 2-to-1 on a reversion to the mean. And if it overshot from Z0 to, and then came back to Z minus 2 where you bought it, what if it overshoots to Z2 on the other side? Then you would have a 4Z frame. And so I can trade from Z minus 2 to Z plus 2, and that also coincides with, on the fat part of the bell curve, you're trading from the extreme departure to the river, reversion through the mean and beyond in a normal distance and back, and you end up going from Z2 to Z2 in perpetuity, and that's how you can do band trading. But it's adjusted to whatever the current size of these excursions are, which is statistically updated every bar. So it automatically, dynamically scores for you. There is some target where you set, if I bought here, my target is the Z plus 2 or the Bollinger Band mean from the time that I bought it. Now, that starts to decay a little bit, so there's a time series in there. The longer it takes to get there, the less likely you believe in the trade. But if this was a sharp sell-off, a sharp recovery might just be the fake one go-to. And so you're buying it, you get alerted by an excursion beyond Z minus 3, you buy Z minus 2, you aim for the Bollinger Band mean, and then you're ready to start 2-hour battle drill at Z plus 2. Now, and then if that works, you might get some kata 2s. So what we're doing is we're looking for statistical anomalies. The WMB3 is one of the ways to match that pattern, but the reason we added the RLCO framework was so that we could get unique insights into what an abnormal move means at this time of day. At this time of day, it takes a move beyond this level to get past Z3, whereas early in the day, it's only a move past this level because it was so compressed here. But now that you've had this big move, statistics tells you that the equal and opposite move has to get beyond that level. And that's the difference that adaptive statistics makes. But every bar that prints, it's updating where those Bollinger Band levels are being printed at. So you get a dynamic appreciation for what's the difference between normal and abnormal. So kind of all over the map on that one. But that's what I mean by the width of the z-score. So when I'm looking at the z-scores in the Red River on MACD, it's always kind of the same thing. That a z-score ladder, if once you start thinking in that habit, no matter whether you're looking at a MACD or RL10 has moved to a certain level, the Bollinger Band mean is always Z0 because that is the mean. And then the standard deviation of the last 30 bars tells you how big the move has to be to +1, +2, and +3. And then all we did with the Bollinger Bands with the river and all that, so we just said, hey, look, ±1 was the river. 2/3 of the time in the last 30 bars, price was between those two limits. So that's normal. And that's why a breakout from that's why you don't want to trade inside that, because 2/3 of the time it's just going to stay inside there and you're going to get chewed up. So the first time that you're justified leaving normal is when price leaves the river in either direction. Hey, guess what? You could use the entire width of the river, 2 Z's, as your 1R execution risk. Or 1. If it's a big breakout, I like using just the reversion to the mean and just use that. But then if it does make a big strong move past Z3 and then starts to reverse, now I know that it's coming back towards the Bollinger Band mean at some point, and I can frame that as a 2-to-1. So that's a Z-score trade pattern, which is pattern 7 in generation 1 of the RLCO framework. I love that one. And when you get big gaps at the open, the thing always opens well outside the previous Z3. That's like there was one big red candle that just drove that thing south. And I just say, all right, OR3, there was your low of the OR3. There's my MMRB. I can buy that on the way up. Or if it breaks down, I'll just buy or short the continuation. I don't care. Because I always know before the market opens what my MMRB was, because that came from the previous day's report. Automatic trade framing. The bigger the gap, the better I like it, because it's in play, and the next move is going to be large, because the first move was large. The first move was the size of the gap. That means there's all kinds of emotions and abnormality that's got to be processed in shenanigans. And I'm just using statistics. And the size of the volatility doesn't affect my MMRB at all. In fact, the quieter it was in the previous 30 bars, the smaller my MMRB was, the bigger my R multiple is going to be. Easy. Standard work for abnormal conditions. All right. All right, that's everything I got to cover. I want to cover for tonight. I got 20 minutes to get the daily report done. Listen to this again, and look for that WMB3 stuff. If you go into the campfire, there's hundreds of case studies of WMB3, and I'm 90% sure there's a video on that in the foundations course too. WMB3, rock solid. I've been doing that for 25 years. It's really straightforward. A nice way.
Thank you, Ken.
A nice way to get especially on big gap days, because on big gap days the Bollinger Bands and the regression lines are slow to react at first. But now you can get something like this, and like you can't even get in on this one until you get the first breakout. Because even if this triggered the oversold, which it would have because the previous 10 bars were all up in here, this thing has to print Now you go to the MACD uptick. This thing won't make the MACD uptick. This one might. And then you might end up buying this here. Or you end up buying this one here when it breaks out above that one. One of those two is your entries. Your stop was down here. But when this doesn't even get to the Bollinger Band mean and starts to fail, you just cut that one right away. Done. And then you could stop and reverse that because the big move is down. And the dragon is failing. The Bollinger Bands are expanding to the downside. The PSAR is pointing that way. You have no hesitation getting short here or even here. And you get that whole move. So that's everything I want to cover for tonight. And we'll see you shortly.
Thank you very much.